The $14 billion buyback trap. Intel just burned $7.7 billion in cash to buy back a minority stake in its own Irish factory, proving that its former smart capital strategy was effectively a high-interest payday loan. This desperate move to reclaim Fab 34 from Apollo Global Management has left a massive hole in the balance sheet exactly when the company needs to scale 14A production. To plug the leak, Intel is fast-tracking the Altera IPO, but don't call it a strategic spin-off. This is a liquidation event designed to provide a liquidity bridge for a Foundry business that is currently incinerating $2.4 billion every single quarter. Next, we look at the actual valuation math that the press release conveniently ignored. The 50% valuation haircut. When Intel bought Altera for $16.7 billion, it was the crown jewel of its programmable logic strategy. Today, the Silver Lake deal values that same unit at just $8.75 billion, a staggering 50% destruction of shareholder value. This haircut is the price Intel is willing to pay to deconsolidate Altera's R&D burn from its main P&L. By moving Altera off the books, CFO David Zinsner can show improved operating margins on paper. But the reality is that Intel is selling its most profitable, high-margin buffer to fund a low-margin Foundry business that hasn't found its footing yet. And the accounting maneuvers get even more aggressive when you look at how Altera is now being labeled as an external customer. Foundry losses and the external customer illusion. Intel Foundry reported a 45% negative operating margin in Q1 of 2026, and a significant portion of its supposed growth is coming from Altera itself. Now that Altera is an independent entity, its internal orders are suddenly classified as external Foundry revenue, an accounting trick that pads the growth narrative without adding a single new customer to the ecosystem. While CEO Lip Bu10 points to partnerships with Google and NVIDIA as proof of concept, the true external revenue remains a rounding error compared to the billions being poured into concrete and equipment in Arizona. Intel is essentially cannibalizing its own portfolio to make the Foundry business look like a viable third-party competitor. This leads us to the ultimate gamble hidden beneath the IPO filing, the signal under the noise. The Altera IPO is the final admission that Intel is no longer a chip design powerhouse that happens to manufacture. It is now a construction and services firm that is liquidating its intellectual property to pay for its fabs. By stripping away Altera and potentially parts of Mobileye, Intel is removing the only segments capable of generating the high margins required to offset the brutal depreciation of a leading-edge foundry. If the 14A process doesn't hit target yields by 2027, Intel will have sold its safety net to build a factory with no high-margin products left to run through it. For operators and investors, the IPO isn't the story. The real metric is the utilization rate of the new fabs once the internal Altera volume is no longer guaranteed. Watch the specific yield milestones for the upcoming 18A ramp-up as the only true indicator of whether this asset stripping strategy actually pays off. Subscribe for more